$460,000 gone, not from a crash, not from a bad bet, extracted from the average American retirement account while the owner slept.
Wait, hold on. You're saying the account itself is the threat?
The structure inside the account, built quietly, designed precisely, running against you right now, today, while your balance looks perfectly fine.
That's not a glitch. That's a feature.
It was always a feature, and the people who architected it understood compound math better than anyone alive, which is exactly why they buried the mechanism where no one looks.
How long has this been running?
Decades, silently, legally, at scale, and here's the part that should stop you cold. The damage doesn't show up as a loss on your statement. It shows up as a ceiling, one you won't see coming until you're already at retirement age, staring at a number that's $460,000 smaller than it should have been.
That's not a rounding error. That's a second retirement account. Just gone.
Transferred quietly and legally upward into the revenue streams of fund managers, plan administrators, and record keepers who never once sent you a bill.
How does something that catastrophic stay invisible?
Because the extraction mechanism was engineered to be invisible. No alert fires, no deduction line appears. It runs inside the pricing architecture of the funds themselves, compounding silently against you every single day for 30 years.
I need to understand how this machine actually works, because right now I'm realizing I might be bleeding and I don't even know where the cut is.
Then we go layer by layer, starting with the one number inside your retirement account that almost nobody alive has ever actually looked at.
Let's tear it open.
The number's called the expense ratio. It lives inside every mutual fund inside your 401k. And most people, after years, sometimes decades of contributions, have never once checked it.
I'll be straight with you. I've had a retirement account for 8 years. I couldn't tell you mine right now if you put a gun to the table.
Most people can't. And that is not an accident. The number is technically disclosed. It's real, it's visible, but it's buried inside compliance documents written specifically to inform without alarming. Language engineered for legal protection, not human comprehension.
Hidden in plain sight.
Exactly. Now connect it to your daily reality. Inflation's already eating your grocery bill. Housing costs have outpaced wage growth for a decade. The tax structure quietly extracts more from middle-income earners than most people realize. You're already being compressed from the outside.
And the fee structure is compressing from the inside simultaneously.
Two vices, one target. Most workers are caught between both and only aware of one.
Give me the actual numbers.
The average actively managed mutual fund in a retail 401k carries an expense ratio between 1 and 1.5% annually. Layer on the plan administration fee charged by the provider running your employer's plan. That adds another 0.2 to 0.5. Some plans embed advisor compensation directly inside the fund structure itself. When you total every layer, a significant portion of American workers are sitting inside plans with an all-in cost between 1.5 and 2.5% every year, quietly.
And not one person handed them a bill for any of it.
Not once. Because the fee never leaves your account as a visible deduction. The fund simply grows slightly less than it otherwise would every single day. Invisibly, the daily net asset value just runs a little slower, and the gap between what you should have and what you'll actually get compounds silently for 3 decades.
This is a rigged table. The people who designed this understood exactly how compounding math worked and built the liquidity extraction directly into the architecture.
That is a precise description of what happened.
Then why are ordinary workers exposed to this at all? Institutional investors, pension funds, university endowments, they don't pay these rates. Why are working people charged more?
Leverage. A university endowment managing $5 billion walks into a negotiation with weight. A 35-year-old contributing $400 a month has zero negotiating position. None. The system charges the people who can least afford it the most, consistently. And here's the number that makes it concrete. 2% annual drag compounding over 30 years doesn't reduce your final balance by 2%.
It's so much worse than that.
It reduces your ending wealth by nearly 40% compared to identical contributions in a low-cost structure.
40%. That's not a fee. That's a second mortgage on your retirement that you never agreed to and never once saw on a statement.
And the people collecting it have been doing so quietly, legally, and at industrial scale for decades.
Why hasn't anyone shut this down?
Because the line between legal and fair isn't always where people assume it is, and the industry spent considerable resources ensuring the regulations that exist don't fully close the gap.
So the system isn't broken?
No, it's functioning exactly as designed. The only question is, but for whose benefit? Let me show you the side-by-side the industry never models in plain language. 2 workers, identical salaries, identical contributions, identical market returns, 1 variable, the fee structure.
Same inputs, different machines.
Worker 1 is in a low-cost index fund, expense ratio of 0.05%, essentially frictionless compounding. Worker 2 is in a typical actively managed mutual fund portfolio inside a standard employer-sponsored 401k, all-in cost of 2.2% annually. Not an extreme case, completely ordinary.
And the gap after 30 years?
Worker 1 retires with approximately $1,100,000. Worker 2 retires with $640,000.
That's $460,000.
Gone. Not to a market crash, not to a recession, transferred. Quietly, legally, from the retirement account of a working person into the revenue streams of fund managers and plan administrators, while that person watched their balance grow and assumed everything was fine.
$460,000. That's not a fee. That's a life. That's 20 years of financial cushion, the last 20 years of someone's existence, quietly redistributed upward while they were trusting the system.
And here's what most people never reach because they stop at the fee conversation and never ask the next question.
Which is?
Where does that money actually go, specifically, with names attached?
Can you answer that?
The 10 largest mutual fund companies in the United States collectively manage over $25 trillion in assets at an average fee load of just 1%. That's $250 billion extracted from investor accounts annually, every year. Recurring, guaranteed, regardless of whether the funds actually perform.
Regardless of performance. Hold on. Repeat that.
The fee is not contingent on returns. A fund can underperform its benchmark for 5 consecutive years and still collect the full expense ratio every single day. The fee clock never stops.
So the entire premise of paying for active management is a lie. You're not paying for results. You're paying for access to a system that charges you whether it works or not.
And the data confirms it. Over a 15-year period, approximately 92% of actively managed large-cap funds underperform the S&P 500 on a net return basis after fees.
92%.
92.
The product being sold to ordinary retirement savers fails to deliver on its core promise 9 times out of 10, and still charges premium fees while failing. That's insane.
And the institutions that would cover it are often financially entangled with the institutions that benefit from it. The disclosure framework was designed to inform without alarming, compliant on paper, engineered for disengagement in practice.
Keep it technical. Keep them confused. Keep collecting.
That's one description of a $250 billion annual revenue model. And before we go further, there's a document buried inside your retirement plan paperwork right now. A document that doesn't just describe the fee structure, it names the names, shows the actual money flows, and reveals exactly who built this architecture and why. Most people don't know it exists, and the ones who've talked about it publicly, few industry insiders discuss it publicly.
When do we get there?
Soon. But first, you need to understand the second weapon, because fees are only half the extraction mechanism.
Stop. No more theory. What do I do with my money tomorrow morning? Because I'm sitting here realizing I may be hemorrhaging $460,000 from my future, and I need a concrete protocol right now.
You'll get it. But if you skip this next part, you'll get the protocol and still do nothing, because that is exactly what the data shows happens to most people, even after they understand the problem.
That's a brutal thing to say.
It's the most important thing I can say. After fee disclosure improvements were mandated in 2012, the majority of plan participants never changed their fund selections, not once, even after being shown the numbers, even after seeing the damage in black and white.
Why?
Because the human brain treats inaction as safety. Changing your retirement allocation feels risky. Leaving it alone feels neutral, even when leaving it all alone is the more destructive choice by several $100,000. The industry understood this. They built the default options accordingly.
The default option is the most profitable option for the provider.
Always. And defaults are almost never changed by the majority of participants, which means the systemic extraction operates on two weapons simultaneously: the fee architecture and human psychological inertia. Two weapons, one target.
So what actually separates the people who escape this from the ones who don't?
One decision made early. The people who neutralize the fee drag are not more sophisticated, not wealthier. They don't have access to private funds or insider products. They simply made one structural decision at the right moment.
Which is?
They looked up the expense ratio on every fund in their plan. They identified whether a low-cost index option existed, and they moved their full allocation there, permanently. That's the core move.
That's it.
For the foundation, yes. Someone who moves their entire allocation into a total market index fund at 0.05% today immediately eliminates the majority of the fee drag compounding against them. Going forward, the past is gone. The future is recoverable.
What if the plan doesn't offer low-cost index funds?
Then the protocol adjusts. Contribute enough to capture your full employer match. That match is an immediate guaranteed return. No fee structure can fully erase it, but beyond that threshold,
yeah?
Direct additional contributions into an IRA opened independently outside the employer plan entirely, where you control the fund selection and can access index funds at near zero cost. The employer plan isn't always the optimal vehicle for every dollar you save.
The match makes it mandatory up to that line. Beyond it, the math shifts.
Correct. And this is information that would have permanently altered the financial trajectory of millions of people if they'd received it at 22 years old.
Which is precisely why it isn't taught in schools, isn't covered in employee onboarding, isn't the first thing a plan administrator volunteers when you sign the paperwork.
The most dangerous investor to this industry is a boring one. Someone who selects a low-cost index fund, sets automatic contributions, and never touches it again.
Boring wins.
Boring wins by $460,000. The final document is called the 408B2 disclosure. It is a federally mandated report that every employer-sponsored retirement plan is legally required to produce. It names every service provider connected to your plan, lists every fee, shows precisely where the money flows and who receives it.
And almost nobody has ever heard of it.
Because while employers are legally required to receive it, they are not required to distribute it to employees. You have to know it exists. Then you have to request it directly. It is compliant on paper, invisible in practice.
That's the architecture right there. The whole thing in one sentence.
Here's your 3-step action plan. Execute all 3. No exceptions.
Go.
Step 1. Request your plan's 408B2 disclosure from your HR department, not next quarter, this week. Read every line listing a service provider and a corresponding fee. Add those numbers together. That total is the annual cost your retirement account is paying to maintain a system you never designed, never negotiated, and never agreed to. Most people will be genuinely shocked by that number.
Guaranteed.
Step 2. Log into your retirement account. Pull up the full fund menu and every option available inside your plan. Find the expense ratio column. Sort by cost. Identify the lowest cost broad market index fund available. If anything exists below 0.15%, move your full allocation there immediately, unless you have a specific data-supported reason not to.
And if no low-cost option exists inside the plan.
Step 3. Open an IRA outside your employer plan entirely. Contribute the maximum beyond your employer match threshold into that account. Select a total market index fund from Vanguard, Fidelity, or Schwab. Expense ratios on those funds fall as low as 0.003%. That is the closest approximation to frictionless compounding available to an ordinary investor operating inside the current system.
3 moves. Request the 408B2. Audit every fund. Build an outside account if the plan is compromised.
Execute all three and you neutralize the majority of the silent systemic extraction compounding against your future right now. But hear this clearly.
The warning.
The retirement industry is currently lobbying against expanded fiduciary regulations that would legally require advisors to act in the client's best interest across all account types. If those protections erode further, the limited guardrails currently governing fee structures inside retirement plans could be dismantled. The window to restructure your allocations under current protections is open. It will not stay open indefinitely. The people repositioning today are not being paranoid, they are being precise.
Let me close this out. What we've laid open today is not a theory. It is a documented, legally embedded systemic extraction mechanism that quietly transfers hundreds of thousands of dollars away from ordinary workers across the arc of a career. $460,000, transferred before retirement even begins. The fee is invisible, the compounding damage is permanent, and the entire mechanism depends on one thing: you never looking closely enough to see it. That ends today, because the next file we're opening goes somewhere the retirement industry considers far more sensitive than fees. And if what you heard today made you uncomfortable, what's coming next will permanently change how you see every financial institution you've ever trusted. Be there when we open it.